Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with Oliver Brown of RC Brown to talk about the RC Brown AIM IHT service. Tell me about RC Brown and also tell me a bit about your own experience.
So RC Brown Investment Management runs portfolios for a range of private clients, charities and pension funds. We've been in existence for over 30 years. I've been with the firm for 15 years and I head up the AIM Inheritance Tax Service and also run a UK equity fund. And prior to that, I trained as a chartered accountant.
So Oliver, tell me, what are the objectives of the AIM Inheritance Tax Service?
If an investor holds a portfolio of AIM Inheritance Tax qualifying stocks for a period of at least 2 years, then this will qualify for 100% business relief, which means they can then be passed on without incurring any inheritance tax. And it allows the individual to keep control of their assets for longer rather than perhaps giving them away.
Tell me about the types of companies that you look for. What are the characteristics?
So we like companies that are either market leaders in their sector or have a particular uniqueness in their sector. We believe that this makes it harder for competitors to take market share. It raises the barriers to entry. We like companies that have got good growth and can continue to grow their revenue and profits over time.
And what sort of companies do you avoid? What are the red flags?
Well, as investment managers, we always like to keep an open mind when we are considering potential investments, because of course, companies change, the world evolves over time, but we would look to avoid companies that are very early stage and are really just a business plan at this stage, because we simply do not know how long it's going to take to come to fruition, if indeed it ever does come to fruition. We also look to avoid companies where we perceive there to be a binary outcome. So for example, there may be a healthcare company that is looking to get regulatory approval for one of its drugs. And of course, if it gets regulatory approval, then the shares will do very, very well. But if it doesn't, then the shares may well be worthless. So we would look to avoid a situation like that.
And do you often looking for primary opportunities? Can you tell me more about that? What does that mean and why is it such an attractive investment area?
So we like to invest at the stage a company is raising money, and we call that primary opportunities. And the reason we like to do that is because companies, if they want to raise money, they need to open their books to us and to other institutions. We can speak with management, we can get to know and understand the company, and that results in there being a far smaller chance of there being a nasty outcome further down the line and it being a poor investment. Another reason is we are able to buy shares typically at a discount to where the shares are trading at, because if a company wants to raise money, one of the ways it gets new investors to put money into the company is to offer them at a discount. So we're buying in a little bit cheaper than other investors typically can, and over time this will add good value to the portfolios we run.
And are you seeing lots of opportunities in this type of investment at the moment?
Yes, we are. So we've been very busy for the past 18 months. 2020 was more about companies that needed to raise money to protect their balance sheet as a result of the pandemic and the uncertain economic outlook. But this year, 2021, it's been far more about companies wanting to raise money in order to expand. We're seeing a lot of companies on the AIM market. They are agile, they're nimble, they've got entrepreneurial management, and they're really seeing the opportunity to raise money and therefore expand into this economic rebound.
And do you want to talk about some of your recent investments, what you've made and why?
Yes, so we've recently invested in a company called CMO Group. It is an online retailer of building materials. It very much wants to become the ASOS of building materials. Now, we like the company because it's growing very quickly at over 30% a year. And you have to remember that pre-pandemic, this was an industry that hadn't really gone online. Everyone would go to their local builders merchants and buy the goods there. And the beauty of CMO is that it's got over 75,000 lines of stock online, which is way in excess of what you'd find in your local stores. So we think it's very well placed to benefit from this trend online. Another company that we invested in at IPO also is a company called Kitwave, which is a wholesale business which supplies frozen goods, ice creams, drinks and confectionery to the convenience store market and also to some independent pubs and restaurants. Now, it's not the sexiest business that's ever come to the AIM market, but it wanted to raise money because it's an industry that's very fragmented and they see a really good opportunity to consolidate the industry, and that will help them grow their revenues and their profits. It's also, we believe, on a very undemanding rating and is due to pay an attractive dividend.
And what about some of the old investments you've made?
Yes, so we hold a company called Essensys, which is a software company that sells its own software to landlords who operate flexible office spaces. This we felt was an industry that was going to do well, and certainly since the pandemic has arrived, we believe that the future of office spaces has changed for good, and tenants increasingly want greater flexibility in the office space that they have, and they want to take out. They may want to increase it, they may want to reduce it. They don't want to be tied to really long leases. So Essensys has done well, and they've got a really big market opportunity. It's a global company, but in the US there's real opportunity for expansion for them, and we believe they're well placed to take advantage in what is the largest market in office, being the US.
So in effect, you mentioned the pandemic there. How has the pandemic in general affected your portfolio? Well, what's been good, what's been great, what's been bad?
Yeah, well, I mean, the AIM market suffered very sharp falls last February and March, along with all global equity markets, as the effects of the pandemic took effect. But actually what we saw was a very, very sharp rebound in the AIM market. And actually the AIM market has outperformed its larger brethren, such as the FTSE 100, because it's got more growth companies in it, whereas the FTSE 100 has more of a value bias. And the AIM market currently, as we sit, stands at or around its all-time highs. So in terms of our portfolio, we used our primary opportunities process to invest in some companies that were having some short-term difficulties as a result of the pandemic, the likes of travel and leisure companies that their businesses effectively had been closed. And we saw the opportunity to buy into some high-quality businesses. So we purchased Jet2, a leading foreign travel operator that raised money in order to protect its balance sheet. And now, as the economy and as foreign travel just starts to open up, we think it's very well positioned to take market share from weaker competitors.
And when's the time to sell a stock?
Our primary opportunities process means that we come across companies fairly frequently that we actually really want to invest in because we think they're going to improve the performance of the portfolio. So therefore we need to look to sell a stock in order to fund it. Now, we may be selling a stock that is in a similar sector because we always want to keep a well-diversified portfolio, and we'll be selling a stock that we feel has performed perfectly well, but we feel that we've made most of the returns we're likely to make in the medium term. We may also look to sell a stock where there has been a profit warning and we no longer have confidence in the company.
And is there much portfolio turnover?
Well, we're certainly not afraid to be active in our portfolio management because ultimately, if we're finding new opportunities that we believe are going to add value, we're buying it a bit cheaper than the typical investor, then this allows us to add performance to the portfolio. And importantly, because we do not charge any dealing fees, then us being active in no way costs the client any money.
If someone came to see you saying they want to invest in AIM ISA, how risky is it? How would you explain the risks of investing with you?
So it's a concentrated portfolio of around 25 to 35 stocks. They tend to be smaller companies. They're growth biased as well. So there's likely to be some volatility. An individual will have to anticipate or expect that there will be more volatility than perhaps their own pension fund, which will have a broader spread of funds and stocks and asset classes and geographies. But I have to say, over the last few years, there's been something of a coming of age of the AIM market, and we're seeing an increasingly high quality of companies on the AIM market. And I certainly think that it's very, very possible to build a high quality portfolio of companies that should do pretty well over the long term.
Ollie, if our clients want to invest in an AIM ISA, why should they consider you?
So at RC Brown, we've got a very experienced team. We've been investing in smaller companies for a long time. We've been investing in the AIM market since its inception 25 years ago. Our primary opportunities approach is well proven, and the portfolios have performed strongly since inception. And I also believe that our portfolios, our costs are very competitive compared with others as well.
Oliver Brown, RC Brown, thank you very much.
Thank you very much.